I compile my information here and there. I can find where I can fit at some point.
Well, that's very, very empowering. That's something good to hear. Yeah, thank you very much. And I'm happy that you started seeing these things just like within 1 or 2 weeks of talking about these elements.
Yeah, bro, really, when you look at the chart,
Mm.
like you can see the chart communicating and you can understand this is saying this is saying that. So I really believe the only problem I now have is an empirical problem that with time I will really catch up.
Yeah, exactly. And it's the beginning. Also, actually, to be frank with you guys, we're also still trying to digest all this, to make it like, to refine it. We still have issues. Eh? It's it doesn't just happen like within 2, 3, 6 months. You're like spark, like you're top notch. No, it takes time. But the good thing is that you guys have started on, like, we've already gone through most of these things. We've struggled with them, and so we try to filter out the noise and we try to share it with you. In doing so, we're also benefiting. I will not lie. How? We realize that when we keep doing this, it takes us back to refine our knowledge and our own understanding of this. So in doing so and repeating it over and over again, also become masters at this. You get.
Yeah.
Yeah, so we're also benefiting in one way or the other. So it's like someone tries to learn something that it could take you years, but if you start sharing your journey, even though you haven't reached those top heights that you're dreaming of, but the moment you figure out something and you start there and then of sharing it with other colleagues, I think that's the good, like that is something good to do. So on our side, main on my side, it has really helped me. Also go back in the notes. Most of the things I'd even forgotten, you get. But you guys also challenge me to go back and reread these things and also get to see things that I maybe I used to miss out. You get.
Yeah.
Yeah, so we're on the same journey just now. And I hope by just time, just time. So I'm seeing Tommy, I'm seeing Mahad, Armstrong is also here, and Ida. You guys, you're welcome. So other blocks have really drained people. So that's why I say I'm not adding anything on other blocks. I'm going to just shift to what? But as time goes on, we're going to start. It will reach a time whereby you also don't use other blocks. You use something else, like maybe FVGs, stuff like that. And maybe others are like, man, for me, other blocks. Because you're going to see that the setups will be seeing like a lot of confluences. By confluences, I'm meaning like a lot of PD arrays are in play. You have FVGs, you have inverse fair value gaps, you have swing laws that have turned into intermediate term highs, stuff like that. You have inverse fair value gaps in play. Eh? So it's going to reach a time whereby you don't even focus on other blocks. You like game time on time, and that's where I want us to reach by the end of this week. Just time and then everything is like, yeah, this is what I'm looking for. My prayer is by the end of this bootcamp is that you guys find something to look for in the market when you open the charts like this. You have your goals, you have your key points, like a checklist. I need to look for this, I need to look for this. First of all, I look at time and where price is. Then when I see something, maybe price has reached a certain key level at maybe at 1 hour, then I go down to 15 minutes. I check if there is unexpected reversal or continuation. Okay, if it's going to be like that, what are some of the confluences that are going to to make price to reach those levels? You get confluences like fair value gaps, inverse fair value gaps, market structure, market structure shifting, or like order blocks. Yeah, you get. Then you refine your entry and you're like, boom, that's my entry. I enter. You get. That's what we want. When you open a chart, you're not gambling. You know what you're looking for. And the moment you don't sit there, you chill. You wait for another cycle. You wait for another cycle. You wait for another cycle. The moment you see it, you enter. Even though it fails, but you've entered on your rules, you'll be like, I checked this was it was there, I checked this was there, I entered here, my target was this, but I was taken out. You'll be fine rather than someone who will be taken out today, tomorrow, the other day, without reasons, without knowing when they are just gambling stuff. You get. So even if you lose, you know why you lost. Maybe there is something that you didn't see. Maybe the market was not favorable enough. There are situations whereby the market is like a crazy person, something like that. So you can't do what? You can't engage. That's why we look at the economic calendar, things like that, to show us that is there something that we can do today, or are the conditions favorable? Are there bank holidays, stuff like that? So not every time is going to be a trading day. However, will be there will be setups in every day, but it doesn't mean that you have to take all the trades. You get you can't milk the market. Actually, that is one of the points we talked about at the beginning. Greed. eh? Greed is when someone, after knowing about a certain element, like a certain method of how to attack the market, maybe to trade, you see him in the market every day trying to milk it. You cannot. Eh? You're going to get fatigue for nothing. You're going to lose it, and you start doing things out of your what your set rules or protocols, and then you're going to lose at the end. In the end, so with this, I think we should start. Maybe someone to give us an opening prayer. We just start. Yes, the mic is yours. Whoever is ready. So, Ivan, are you taking it on? Yeah.
Okay, let me take it on.
All right. Thank you.
But Willie, before
Yes.
we pray,
Okay.
I'm going to request you something. Last time you promised that in the end of the sessions you're going to come up with a PDF or something for this.
Yeah. 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 Yeah.
But then I would also request something.
Okay.
Please, either at the end of that PDF or in its beginning,
Mm.
I would request you, if that's okay with you, you sit down and have out some summarized kind of an encyclopedia of all the things that influence the market according to you.
Okay.
For example, apart from those contents that we shall be having for
Mm.
what, if it is what, and that,
Mm.
uh, let's have something that is a format of an summarize, some sort of a
Oh,
summarized
like a
whole,
structure.
yeah, the whole structure of what you think can affect a trade.
Okay.
So
Maybe
that
you're meaning what you can base on to like trade.
what you can best to enter a trade
Okay.
in a summarized format so that every individual can look into the things
Mm.
in particular one after the other to have that real content that this is a way to go.
Okay. All right. I've noted that. I think what we'll
Okay.
do. before it's out, we'll first I'll we'll go through that list, and then the last week we'll be trying to follow that list, and as
Yeah,
we engage with the markets like together, you get like everyone
yeah,
live and giving their opinions according to the
yeah.
rules. Have we seen this? No. Have we seen this? Yes. What do we do? What did we say we do when we see this? We mark it, stuff like that. You get, we follow that throughout the 5 trading days or 4 trading days, and you see how it works. You get, but after
Yeah,
learning all these things, all right. Hmm?
okay, let's pray.
All right.
Father, we thank you for today. We thank you for the session that we are going to begin. We thank you for each and everything, Almighty Sovereign, that you've provided us in the course of the day. We thank you for your provision, for your love, for your care, for the instructions, Father, that you have been leading us throughout the course of the day up to this point. But I know it's just at the beginning of the week, and Almighty Sovereign, at the beginning of the month. We thank you, Lord, because you're going to take us through all this week to the end. In Jesus' mighty name I pray.
Amen. Thank you very much. So let's get started. So there is a statement in front of you. I hope we've all seen it. Try to read it and see if you can understand what it means. Anyone? You can type in the comment section if you've really got something out of this statement. It's saying every single retracement followed by an expansion is a lower time frame MMM. MMM is a must, refers to market maker models. So we are saying every single retracement. I hope everyone knows what a retracement is. Retracements are like repricing, going back. Maybe the market has been sloping down, now it retraces back somewhere up. You get. So we call that a retracement. It has retraced back. If it has been going up, then it retraces back down or lower slightly, and maybe it continues like that. So we call those retracements. So what about an expansion? An expansion is whereby you see maybe green candles, like a, a push, like there's something we talked about earlier about was called the topic was what? When we're talking about this imbalances, it's called distribution. Yeah, yeah, distribution. It's like expansion when the market expands to reach certain height. Maybe it's in a hurry to reach, to catch up with certain gaps or key levels with time, obviously. So we call that an expansion. Now, when we look at this chart, you will see here these big candles that pushed up. Where's my arrow? This one, these up close candles, the candles that are going upwards, those ones, that is an expansion. The market expanded where? Higher. You get it? The market expanded higher. Yeah, please try to be practical. Okay. The market expanded where? Higher. So that is what I'm referring to as an expansion. It expanded like the way you expand a rubber band. You get, yeah, the way you pull it to reach a certain height or level. That is an expansion. So here the market was sloping down slowly by slowly, But after reaching some key time level, it expanded. That is the retracement I'm talking about. It goes back. So it has been sloping, retraces back, keeps sloping, then it expands. So the terms I'll be using them interchangeably. You get. So that is the statement. So every single retracement followed by an expansion is a lower time frame market maker model. Now, lower time frame. What do we mean by lower time frame? I hope we talked about time frames, eh, the other week. Time frames, everything is about time, but the time frame determine the candles that you're looking at the data. If we are, for example, right now we are in a 1 minute time frame, you can see that. So it's a one. Let me see if I can zoom in for you people. You can see here, 15 seconds, 1 minute. So if you see 1 minute, that means it's a 1 minute time frame. 1 minute what? Time frame. So 1 minute is lower time frame compared to 3 minutes. So if we are in a 1 minute, that means each candle that prints that you see, it took it 1 minute to open and to close. Then another candle will also do what? Open and close after another 60 seconds or 1 minute. Then 1 minute is slightly lower. It will be considered a lower time frame to 3 minute time frame. So if we switch to 3 minutes here, we'll notice that the candles have also changed. So instead of having one candle to one candle to that takes 1 minute to open and to close, and a new candle starts again, is printed again. When we switch to 3 minutes, that means each candle, it will take it 3 minutes to open and to close, and then another candle will be printed like that, like that. If we switch to 5 minutes, that means each candle that you saw on a 5 minute chart or time frame, it took it 5 minutes to do what? To print. 5 minutes of what? Of time. How do you know that? Now, good enough trading view as a countdown. So for every candle that prints, we can look here. And where you see USD, where there is price, you say countdown of time. And that one, now that is a new candle that is being printed. You can see 54 seconds, 53, like that here. It goes on printing, sorry, counting down. When this changes to black, that means it's a bearish candle. If it changes to gray, since my candles that are meant to go up are gray, they change to, it changes also to that color. You get. So this is how you notice. Now let me switch to 3 minutes. You will see. Now the candles reduce a little bit. Now here you're seeing that this 3 minute candle, for it to get done, a new one is printed. We still have 1 minute to go. 1 minute and 12 seconds, 1 minute and 11 seconds, 1 minute and 9, like that, until zero. Then a new one will do what? Will start counting. So like that. When we switch to 5 minutes, the same story. Now you're going to notice that candles are reducing in number. Candles are what? Reducing in number. Let me now zoom out because this is chaos now. Okay. That's why people actually, because of time frames and time frames, yeah, people have been choosing the wrong order blocks. You get. So you might be noticing that you might be choosing the wrong order block because of the time that you're looking at, you decided to look at. Now, for example, here, before we go to the market structure shifts, when you look here, this is a 5-minute chart. That means each candle you're seeing here is exactly 5 minutes. Now, this is an order block, the black one, the black candle. So this will act as a revision for people who are still struggling with order blocks. We say an order block is a candle, some of like if it is a bearish order block, bearish is those, sorry, if it is a bullish order block, if it if at all it's a bullish order block, for it to qualify to be called a bullish order block, we want to see that last candle when price was sloping down, that did what led to the takeout of some liquidity, sweeping off that some old liquidity. Now, that candle works as a turning point for price now to change its state of delivery. It has been delivering price lower. Now it is switching to going higher, the way you can see here. Price has been dropping. This is of course a gap, an imbalance, and then now it changes route. You get. So now you look at that candle, and it should be, if it's going to be called a a bullish order block, it has to be a down close candle that leads to price to go up. Now, but when you see here, the last candle is what? If you look at this candle, it's a bullish candle. That one, it's a bullish candle. But now we cannot call this candle a bullish order block. It cannot be. But when we look on the left, hmm, this 5-minute candle, this black one, was the last black what? Candle. Now that forces me to switch. To switch what? To switch time. So that I get clear information. So that I get clear what? I get at least more data that resonates with my definition. So this is not an order block, the one I've marked with green. But when you look here, maybe if I try to switch on the 15 minutes, I could see something. Again, I'm not getting something clear here. So let me switch back to maybe 3-minute IC. Now on 3 minutes, I'm seeing these two candles, the black ones, that sweep this liquidity. Where is that liquidity? That one, that candle. Let me make it red. We have, that is the old liquidity. So maybe that, now let me switch to 1 minute. I see if I can see something. Now on 1 minute there's something a little bit clean. Now when you look on the 1 minute, you can see these three down close candles, the black ones. Now why am I not taking the last black one? However, it's, to me it's not clean. To me it's not what? It's not clean of an order block. So I cannot confirm it. But when I look at this, since the definition of one order block, it can be one candle or it can be a number of candles. So I'm going to take all these three candles. So I'll take them all from the high to the low. From up here, that is the high of that order block, to the lowest point. You get. Now I want to see these candles. So in my head, I'm seeing this as one black candle. I'm seeing it as one what? One black candle. That entire three candle structure that took out what? The only liquid. You can see that here. That this was swept. Now what? When the moment they sweep this liquidity, let me type here. Hold what? Hold the low. Or sell sign. Sell sign what? Liquidity. Why are we calling it sell sign? Because market was sloping down, down, down like that. So that's why we are calling it sell sign what? Liquidity. Mhm. Now, the moment it takes out this, I'm waiting to see if those candles that have took out the old liquidity, whether they also take them out. You get. Now we can see this candle formed, another one formed, another one formed that came back down here and retested. Then market pushed up. And actually, if you can look critical, closely, you can see that this was the last candle that took out the high of this order block. The candle, sorry, the high of this candle, which now it becomes an order block. But again, there is another point I need to look into. Within the takeout of this high, hmm, is there a gap, a volume imbalance somewhere here in this run up to take out this? Then yes, there is. There is that gap. Let me mark it for you. There's this from this black candle. Let me change the color of this. Let me make it blue. So I've made it blue. So people are just coming in, you're welcome. We're doing a little bit of review of what we were discussing last week. Now when you look closely, this is our gap and we know the name of this gap. And when you look where this gap was formed, it's within the range of that order block. Okay? Those candles, the three consecutive candles that took out what? The previous low. Then the moment they took out the previous low, what happened? They also swept them from the bottom to the high. Now the moment they close above them, and then you're now let me look. Where is there any gap within this run up that took out these candles? Which candles? The three candles that took out all the liquidity. Yes, there that is the gap. Now the moment you see such a gap, just know that is now your perfect order block. So this is a fair value gap. Where is it located? Inside the range of an order block. So this signals to you that now it's time for market to change its state of delivery. It has been delivering lower, now it's going to change to now distribute upwards. So now what do? You have three data points that we talked about. From the top to the bottom. Where is the top of the order block? From the tip here to the middle ground, to the mean threshold, then to the bottom. Now what you do, you divide the order block into two equal parts. Why are we doing this? Because of the things we talked about earlier, of the algorithm, that the algorithm will also always do what? Try to distribute to offer fair value. And how does it do that? By making sure things are at equilibrium. Now equilibrium is 50% of any range or any fair value gap or any order block. Now the moment we cut this, we want to see price coming back, tapping where? In the top quadrant. Where is that top quadrant? Is this space. Is the space up. Is what? Is this top part. We said we want to see, there are two things that we discussed. I hope you guys remember these things that we talked about, that price should be doing, that we expect, sorry, that top part, that is our premium level. We expect this part, anywhere that price touches, to act as what? Support, to support what price to continue pushing, delivering higher. So we expect the premium to act as support, and we expect, yeah, to act as support to support price higher. Now the moment you see this candle coming and tapping anywhere, you just enter. You enter your buys, you target some key levels. You get. So I hope this is enough of order blocks. Let me discuss what we had prepared for you guys. We started with a statement. I hope you still recall the statement. This is the statement. But please learn how to switch time frames. You might be dealing with a bad candle. For example, this example you just see, eh? And for you, you're calling it an order block, and you fail to see a clean order block. That is a clean order block, but you're saying it's not one candle, it's a number of candles that did what? Took out some old liquidity. And then the moment they took out that old liquidity, they also took them out. They closed up. Taking them out is this is what we mean. Candles, up close candles closing above the high of those candles that those down close candles that did what? Purged some of the sell side liquidity. Now the other key point you need to note to take a note of, is there any gap within this run up? If there is, then yeah, you, that qualifies to be an order block. The moment you see that now, you see price continuing up, 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 up. Yeah. Okay, so let's go back to our example today. Now there is a statement in front of you. It's saying every single retracement followed by an expansion is a lower time frame. MMM. MMM means market maker. Actually, let me write it in full. Market maker buy or sell model in brackets MMXM. So the X means can be sell or buy. You get. It can mean something else, but that's how we did. So this is a statement. It's like a quote that I'm going to base today's lecture on. So every single retracement that you see, and it is followed by an expansion, it's indeed a lower time frame market maker buy or sell model. What do I mean? This is what price does. To remind you a little bit, goes up, goes down, goes up, goes down, goes up, goes down. Now it changes. Now it changes. So we have our market that has been delivering lower, and then it changes route and delivers where? Upwards. So now how does this connect to market maker buy or sell model? Now the up and down movement, these are what? This is what we call the left side of the market, of the curve, and the right side of the curve. So I'm going to use boxes to illustrate this for you. So I want you to see those boxes where they are. Mm, mm. There is one more that I've forgotten. There is also this. Mm. Now, when the market is sloping down, it's normally red. Let me change this to red, to red, and then this one, let me change it to black or gray. And it's going up, we consider that green, green. Yeah. Now, there is that kind of flag pattern that we're seeing. Now, on the left, on this side, we have the lefty side of the curve. Now, the left side of the curve, this is the bearish what? Movement. Movement of price. In other words, price is bearish, it's sloping down. On the right hand side, we have right side of the curve, we have what? Bullish what? Bullish movement. Movement of price. In other words, price is going upwards. But what leads to this? So this is kind of our curve. Now you're seeing when let me first cover part of this. So you have the red and the what? And the green. The red is the when candles are sloping down. The green is that movement up. Hmm? So the red is the bearish movement, the green is the bullish movement. We've seen this. That's why I'm using these two colors. Now let's first focus on the red side. Hmm? Let's first forget about this. Actually, let me cover this completely. So now here we are seeing price doing what? Sloping, sloping, sloping. Sloping how? Making high, higher high, higher low, higher low. Then on the other side, it's making lower, lower low, lower low, lower low. You get? We know this. So this is a lower, lower low, and a higher, higher high, stuff like that. Hope everyone knows that. Now, when market keeps on sloping like that, when do we know that it's going to change? And what are these boxes that I've marked? You see, doesn't market does not just do this to slope down like this straight. No, if it is to slope down, it does something that you're seeing here. It slopes, retraces back, that move up, makes a higher high or a higher low, whatever it's called. I think this is a higher low. Higher, higher low. don't remember all those things, but anyway, just when it makes a high, makes a low, makes a high, kind of a ladder system. It drops, it retraces. But now, when this high fails to take out the previous high, we just know it's still doing what? Continuing distributing lower. It falls again lower, taking out what? A previous low. Now, the previous low, the moment they take it out and formulate a new low, how do they formulate a new low? By retracing, price reprices somewhere, goes back slightly and drops. Now this becomes a new low. So now this is old low on our sell side liquidity. You get sell side liquidity. Mhm. Yeah, sell side what? Liquidity. So now this becomes your new low. New low. It also, now you see price again drops, makes this new low, then creates a new high. But this new high fails to take out the previous what? Old high. Old, old high. A current high becomes old when a new high has been formulated. You get, so this will be our new. I hope you people are taking notes of this new high. Now that means this is what? Buy side liquidity. This one was sell side. Now this is buy side. Stroke buy side liquidity. Liquidity. Things like that. Ah, you get. So a new high is formulated like that. Now the moment a new high fails to take out the previous high, we just know the market is now still dropping lower. So what is going to happen? People would think the market is now continuing lower, lower, lower. But how do we know? What are these signatures? Time signatures we look at to tell that now market is now tired of sloping. It's now changing route. It's changing its state of delivery from delivering lower to switching to delivering higher. We can see, you remember this statement that I talked about, that in every retracement followed by an expansion is a lower time frame market structure, buy or sell model. Now when we look here, let me zoom in for you. When we look at this, eh, here, and we only remove that section. Sorry, this thing is also giving me issues. This V, kind of a V, and we only remove, extract out that price has done this, then that, then that. So let's first stop it there. This is what I'm talking about. So this is where our focus is going to be. That. So we've extracted it where? From here, from this entire movement low, this one, this whole movement lower. We've just picked out only this. Let me circle that for you. Here's a circle here. We've only magnified this. So if this is on a higher time frame, like 15 minutes, and you say a ladder being formulated, market was going down, then it retraced a little bit and then it dropped. This move only, this is an entire market maker buy and sell what model. This one. Now when we extract that here, let's see. So inside this, maybe if this was 1 hour, maybe this chart was our 1 hour what chart or time frame. So in other words, higher time frame. Higher what? Higher time frame. This. Now we switch from 1 hour to maybe 5 minutes or 1 minute or 15. From 1 hour to maybe 5 minutes, not 5 hours. 5 minute chart. So from here to here. So we are coming from 1 hour to, but out of the 1 hour, we've extracted only this V. Now we're saying this V from 1 hour, it's an entire market maker model. How? We can see that move lower to higher. Now inside this, you're going to see the same structure happening. This is how these things are going to become a little bit easy. How? We'll see price again doing these things. Lower, lower, higher, high, lower, lower, higher, high, lower, lower, higher, high. And reaches here, changes like that. You get. So you will see the same pattern. This, you get the same pattern in place, so we can capitalize on this, and then price will again drop. Maybe on the higher time frame it is sloping down, but for us we can see this retracement. You get. Now the moment price has been making this, we don't expect any high to be taken out for price to continue dropping, but the moment we see this happen, this high, new high, instead of stopping here and then continuing down like that, we see it actually doing this, come and take out this previous what high. Like so, this is our previous high, the one I've marked with green. We mark it with red, so because red is more shouting. That one that I've marked with red. The moment they take it out, a new high takes out a old high. We just know that there is now now the market is now trying to signal to us that it's about time to change its what? Its state of delivery. How do we know? By this information. Now this entire thing here, there we've been seeing order blocks. That is what we call MMXM, market maker buy or sell what model. The X is for means either it can be replaced or exchanged with sell or buy in case the market is sloping down, or in case the market is switching from going up, now it's switching to sell. You get. So we've said, now these are the things we've looked at so far. Let me get a curve for you. Now this is our curve. We're going to see this pattern repeated. We'll go back into the chart. That one, let me make it green. This side, this is the sell side of the curve. This is the buy side of the what? The curve. Our most important thing is between here, down, here, where it changes from what? From selling to buying. That's going to be our focus, to buying, from selling to what? To buying. And we've said this entire thing you see, when you go inside it on a lower time frame, when you go inside, it's the same structure. It happens over and over again. It can be the same here, that pattern that I've marked with thick red. So people, you're welcome who have just come in. We're already starting and we are looking at market structure what? Models. But they are only to either buy or sell. Buy is when the market has been delivering low and then it switches to buying. Sell model is when the market has been delivering higher, and then it switches. So this will be the market. We'll replace the X with B. You get the X with B to mean market maker buy model. That is the buy model for you. Now the sell model is the opposite of this. Is the opposite of what? Market has been going up, going up, going up. It reaches a time and it reverses and takes out the previous low, and then reverses a little bit and then delivers lower. So now this is our market maker sell model. It changes from what? Why are we calling this sell model? Because it has been delivering upwards. Now it changes to selling. It has been buying, it switches from buying to selling. The same rules apply. You get, so buy side of the curve, sell side of the curve. Sell side of the curve, buy side of the curve in a buy model. Now let's go inside here. We look at the key signatures here. Here, what makes price change route and how can we capitalize on this? How can we make this our model? You get. Alright, then I'll also talk about SMT, I think tomorrow. I think we look at to know that now that it's time to change. Alright, so before SMT, okay, so now let me go inside here for you, inside here, inside this inception where market changes direction. Okay, now let me redraw things for you guys. Okay, so for a buy model, let's look at buy model, market maker buy model. Okay, how do you know that it's now changing? When price has been delivering low, makes a lower low, and then goes back up, makes a high, makes a lower low, and then makes another high. That does what? Takes out the previous high. Just know it's time to change from delivering lower to going up. Now, here we need to look at the things we've been talking about, discussing, like order blocks, like fair value gaps. There we expect it to come on top either a fair value gap or an order block, and then shifts higher. So here we expect what? To see it tap into our key signatures, PDRAs, in other words, like FVGs here. Now I'm going to spice it a little bit for you guys to make it more powerful. So that is the first pattern. That is pattern A. A. So you will see that, or the second one that I'm going to to illustrate for you. This is whereby the previous low, this is the old low, old what? Old, old low is taken out. The way order blocks have been working, they have taken out the old low. Now what happens? A new law is created here. A new law is created. This is the new law. Now instead of formulating another law, price runs up and takes out the previous high. This one here. This one, let me change that to green. So this one is the high. Old high. But now that old high is not just a old high. They have taken it out. And the moment they take it out and create a new high, and create a new high, there are things I want you. Who is not seeing the charts? Hello? Can you see it now? People, let me see the thumbs up if you're still seeing this. Yeah, Batram is saying he's seeing it. Maybe you can first log out and then come back in. You get, if maybe there is something that is weird with your presentation. You first log out and then like first close the Google Meet and then open it again. You get, maybe that can fix that. Yeah, you try that. That's how we troubleshoot these things. Okay. Now this new what? New high. Sorry, all the high is also now been taken out, and the new high is what is created. New high. So what do we want to see? Price to slope down to dip where inside any fair value gap that was created by this move up high. Now this move, let me also add on this. You add on this on your notes. What I want to see is for price to do what? To push high, okay, to quickly to rush, a rush of price, like of price higher to reprice high, or like a quick movement. This is why we said never chase price. Never chase what? Never chase price. We make it bold. So this leg that takes out the previous high, we want to see it, like we want to see big candles take out what? Take out this. And the moment the reason why I'm saying we want to see big candles is because anytime that price tries to rush, it leaves what? Gaps behind. So the moment we see candles pumping higher, we know that now, that's a quick rush. And inside a quick rush, we expect what? Gaps left. So this would be a high signature market structure shift or market maker buy model. This is one of the signatures that we will base on to do to fine tune our entries for. Now to buy higher, to know that the market is now heading where it's shifting from selling, now it's going to deliver upwards. It's changing its delivery. Now we've seen fair value. Now this old high, in most cases, now please put this in your notes. Put this in your notes. This old high, this one. If you see it, being formulated as a swing high. A swing what? High. It changed. Before it changes, if you see price coming, yes, Murindo, you're welcome. If you see price, let me put it slightly in the middle. If you need taking a screenshot here, please do. If you see price has been doing this lower, low, higher, high, lower, low, then it takes out this high. And this high, it's a swing. It's a what? It's not just a high, it's a swing. Now what you'll be praying for is this swing high. This swing high. I hope you remember swing high. It's a 3 candle pattern. Let me draw it for you here. Because this is the real deal. This is everything. Okay? If you see 3 candles like this, and then another one can be green, it doesn't matter. For example, we have our candles here. When you see something like this, this is a swing high. Sorry, it's taking me time to draw these things, but I hope you get. When you see a candle being what? Being on top of the other candles, the candle in the middle is actually higher than the candles on the left and on the right. This candle in the middle is what we call a swing high. So you mark it like this. You mark that candle. Please, I will not repeat this because it's for those ones that have showed up today. You mark this candle. How? Like this, and you pull the way you've been labeling your fair value gaps. So you mark it. This is your swing high. Now you're waiting. Now where are we expecting this to happen? This swing high to happen or to formulate? Here. Where you're seeing that? Here. Where I put this, broke this up. That's you see that one. In that point, if you see a swing high, and then the moment they take out that swing high, how? Where? On this leg, they run up higher. You want to see big candles only take it out. Big candles do what? Take it out like so. Why? To leave a gap. In other words, to leave a what? To leave a gap. So the moment you see a fair value gap on the left here that took out this, let me put the wicks for you. Oh my. So that is our swing high. We know what a swing high is. A swing high is a candle on top of the 2 candles that are lower than it. It's in the middle, but the candle on the left is lower than the candle in the middle, and the candle on the right is also lower than the candle in the middle. So you mark that. Now you're waiting to see, you're praying. You're not praying, but you're waiting to see price. This is what you want to see. For price to push higher, take out this, close above this candle. With what? With a gap. Where is that gap? It's here. Let me put wicks for this so that it makes more sense. That candle has its wick. Ah, then this one has its wick. Ah. So the moment you see something like this, this is your swing high, and it has been taken out by what? By a candle. And what happened? What took it out? Another gap. Now you mark this gap. Let me change that to red. Please, people, take screenshot of this. So that is a gap, and you know the name of that gap. It's called a fair value. A fair value gap. Let me make it maybe gray. Let me make it this gap. So this is a fair value gap. Fair value gap. It has taken out what? A swing high. Now this swing high changes its name to an intermediate term low. No, sorry, term high. Sorry. An intermediate term high. I made a mistake. Sorry about that. It changes its name to what? The moment they take it out. Now this is somewhat advanced stuff, but since you people are here today, I'll give this to you. Anyway, so it changes from a swing high. It's still a swing high, but just the moment they take it out, like that, you want to see big candles, like a gap. Take it out. In other words, you want to see candles close above it, and they leave what? They leave a gap, a fair value gap. It can be higher, or it can be lower. Things like that. So that's what we want to see. This is a key signature that we are strong. Now, the moment price comes back and taps anywhere in this gap on the top of this intermediate term high, it's going to continue upwards. Now, on the left again, I'm adding on something else. On the left, you want to see this swing high, the one here, when it was being formulated, and when you looked on the left, in this move down, lower, this move where, lower, this leg, and market came like that, pushed down, then took out this. You want to see when this swing high was being formulated, it formed inside a fair value gap on the left. On the what? On the left. There is a gap here. Now it bounces off inside that gap and then it continues down. The moment they take out this swing and they close above this gap, this fair value gap, the old fair value gap, it becomes an inverse fair value gap. It becomes an inverse fair value gap. Now we want to see a swing high that formulated inside an inverse fair value gap and another fair value gap on the left, like on the left of that swing and on the right hand side of that swing there are gaps. That's a high signature movement. So what do? You place your entry here. in this space and you buy high, you get. Now that is the first signature. The second type, it's a type 2. We call it a type 2. A type 2 reverse or whatever, it's this. It's where price does this. Instead of taking out the previous high, like so, it fails. It does what? It fails to take it out. It fails to do what? To take it out. How has it failed? You can't see. Let me get my eye here. Market has been sloping down, making higher highs, but then the moment for you now you're expecting this to take out this, but it fails and it drops down, dropping where? Inside their gap somewhere or another blow, and it shifts higher. So this is a type 2. You will see this somewhere. People, any questions? Any questions? Any questions? Any questions? So now we get this information and make and reverse it, like rotate it the other way to make the one for sell side. So that was the buy side. So for the sell side, we expect price to be going up, then it literally eventually runs down, taking out what? This low, and then reversing back somewhere and then dropping. So now what do we want to see? Let me repeat this. Market has been going up, and then it reaches that high, comes back down, does that, and so this again, we want to see a gap here, and that gap, if at all this candle here, now this becomes our swing, our intermediate term low, or a swing low, or now it has become an intermediate term low, like that. So the moment you see that signature, just know we are shifting. Sorry, we shifted from buying to selling. So this is called a market maker sell model. Market maker sell model. Why sell model? Because the market has been delivering upwards and all of a sudden it changes its what? State of delivery from buying to selling, from bullishness to bearishness, things like that. Okay, so any questions so far? Yes. Yes, Mark? I saw a hand or something like that. Okay, no hand, so let me continue. So now there are things I've been talking about, these gaps. Now, for example, on the rundown, this gap, you know its name. That's why we started with those terminologies. This one here will be a B, a BC. Sorry, a CB. A sell side imbalance, buy side inefficiency. Or FVG, sell side FVG. This one here. So what happens on the other side? This one becomes your inverse fair value gap. Now, when does a fair value gap become an inverse? The moment market price passes through it, it changes from being a fair value gap to an inverted one fair value gap. It's still in use. So when you see a swing low, formulates inside an inverse fair value gap, and all of a sudden, after taking out buy side liquidity here. The same way order blocks have been working. They have taken out all the highs, and then market drops to take out what? The swing low, the previous low. Now and then in that movement lower, they created a gap within a fair value gap or a CB, a sell side imbalance. Just put your entry inside that sell side imbalance for sales. So that is a type 1. Now a type 2 is like the other one. This is where price fails to take out a high and then instead formulates a lower low and drops down. You see, it fails to take out what? A hold high. In this example too, here. Now you can see in the first example, this high took out the previous one, the old one, but in this example, it fails to take it out, to sweep it, and it drops. You get, these are the two examples. This is the same with other blocks. Other blocks take out the previous high, but there is times whereby it fails. And we don't call that an order block, we call it a mitigation block, something like that, but I'll not talk about that right now. Just know, when price fails to take out the previous high and it again drops, making a shift here, you expect to sell, and you expect to see the same signatures. Inverse, fair value gaps, and what? This is type B. This is our type A. Let me bring them together for your own what? Notes, so that maybe you can take a screenshot. Today's lecture is really kids, what we're going to base all our trades for. So this is a type B. These are our notes today. This is our type A. And you can see here they have taken out. And then this is our guide. So you expect price to come back in that gap. So on the left, we have an inverse fair value gap. Reduce the font size. Have an inverse fair value gap. Let me change this to orange so that there is a difference. So you have an inverse. Also have abyss. That we expect price to do what? To tap into and continue high. So these are the notes of today. But in the second example, the type B, this is the buy model. The type B, price fails to do what? To, to take out the previous low. And instead formulates a lower high or a higher low. I don't know how you call that, a higher low. But it takes out that swing, so that will be our targeted one entry. Okay. People, those are the two types. On each side, we have the market maker buy model and market maker what? Sell model. Any questions? Yes. So that's today's what? Hey, this is the real deal now. This is actually why we are here. Yes, that. Yes, Adrian.
I kindly beg your pardon on type B.
Type B. Yeah, type B. It's whereby the previous law, the old law, the new law has failed to take out the old law. You get the sell side liquidity. Maybe if it's in a bullish market structure shift. The old law, for example, here you're seeing that this line that I've marked labeled with this one, the old law, has been or sell side liquidity. This new law, for something to be, for a structure shift to be perfect off the book, we need to see the old law swept the way other blocks were. That's what we want to see. But in the type B, it fails to take it out. You get it. In other words, instead of having a new law that is lower than the old law, it's called, this will be lower low, this will be a lower high, something like that. This new law fails to sweep the old law. But again, a structure happens where here, here. This is the same thing here. Now in type A is like the way your order blocks work. An old law is swept, is what? Is swept, you can see. It's taken out by what? By a new law, this one. The moment you see that just know that is a type A. A type A. And then what do you want to see? A quick rush. We talked about that. You want to see momentum pushing higher, taking out this new, the high, this one, this line. The moment they take, let me change that to green. The moment they take out this green high, this one, with momentum, with rushness, with big candles, and those big candles leave a fair value gap. Or in other words, they leave a BC, buy side imbalance, sell side inefficient. That's your entry. You expect price to come back in that gap, then pushes higher. You get. Now to make it really like it has to work. It's spiced up. The moment you see this high, on the left there was a gap. Okay? That gap is now changes its name from a fair value gap to an inverse. But the moment you see this on the left and on the right hand side and in the middle we have this guy. Okay? this one here. That's a swing high. The, the moment you see that swing high, and on its left there is an inverse fair value gap, and on the right hand side there is a fair value gap. Just know that is a powerful entry. That's a powerful change of structure, change of state of the mover. That's a powerful market maker buying model for ICT. Actually, this is what we call a a what? A unicorn kind of. Yes, kindly go back to the previous slide so that we can take screenshots. The slides. Let me see. Let me zoom out for you guys. So you let me know if that is what you. So we talked about this sell side of the curve, buy side of the. This is where it all started from, if you remember. But before that, we talked. It all started here. It all started here. If you people recall, with this statement, let me see if you can make this clean for a screenshot. People, this is where we're going to base our what? Structure from, our basis for making entries, looking for entries. So this is because we say every single retracement followed by an expansion is a lower time frame market maker buy or sell model. Now we saw that when the market is sloping down, making these ladders sloping down, these ladders, all those like kind of letter V's you're seeing, those are complete models, market maker buy up, sell what model. Now on the left side of the curve there will be buy models. On the right hand side of the curve there will be sell what. If at all we tilt this, we turn it upside down, it becomes a sell model, like market structure sell what model. But inside any retracement, the retracement is whereby market has been sloping down and then it retraces back up and then continues down, delivers down. This move up, repricing upwards slightly, it's called it retraces, it goes back. Instead of going straight. Why? Because market does not move in a straight line. It goes up, down, up, down. Now, if it has been dropping down, that move up, back up, and then down, the move back up is what we call a retracement. Now, that creates kind of later V-shaped what? Structure. That V-shaped structure on the higher time frame is this. You can see that V, like letter V. Now, that is a structure shift. The market has been dropping, then all of a sudden it changes and then proceeds upwards. Now, whatever you're seeing on the higher time frame, it's the same structure here, 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 it's the same thing here, it's the same thing here, and it's the same thing here. Now we picked this where you're seeing a circle, and we said if we are to pick out only this section of that entire thing, maybe that was like a daily structure or a 1 hour time frame. Let's go to like 5 minutes. So this is what we, so from there, that's why you're seeing this arrow. Let me first remove this one. This green arrow from here, from this to this. So it's like an extraction. Out of this big one, we get out a small portion of it. And it's the same, we saw that it's the same one structure again. Now from this structure, we saw that price From that later fee, we have a sell side of the curve and a buy side of the curve. We again went inside. And extracted this part only, the lower one, the turning point. The turning point. Now the turning point, when price has been delivering low and then it turns, we call it a market structure buy model. In other words, it has been selling, now it changes into buying. It's called a buy model. On the other side, for a sell model, this one, market has been climbing up. Climbing up. This climb up is what we call the buy side. The buy side of the curve. And then this will be the sell. The sell side of the curve. Where is that sell side? Is down this movement low and this drop. But now this shift here, let me increase the boldness of that yellow color. That shift there is what we call a market structure shift for a buy model, market maker buy. Sorry, sell model. This would be a sell model. So here now we extracted this and went here. I hope now that is clear enough to take a screenshot. That one. Now proceed. Now from there we sloped down to see really what happens. What do we want to see inside those shifts here? And we've seen there are two types that I focused on, type A and type B. That's how I named them. Type A is whereby, if for example we are in a sell model, whereby a previous low, old low, has been swept. Previous old low or sell side liquidity has been swept, and then market retraces. In the type B, there is a failure. Market fails to take out the previous old low and then changes its state of delivery, things like that. The same happens in a sell model, whereby the market has been going up and then changes its state of delivery to begin selling. In the type A of a market maker sell model, we see all the highs being done what? Taken out. Let me change this to green. So these are all the high. We also make that green. All high. The moment in the type A, the old I is taken out. Again, you're seeing that here, it has been taken out, and then they come and they sweep the swing low here. The moment they sweep that, the moment they take out the previous order, what are you waiting to see is this: for price to drop with momentum, with big candles and leave gaps. Drop below where you want to see price close below this swing low, this low in the middle, like a triangle, like a V, and then in those gaps you expect price to come back and to retrace back and retest it and then shoot lower. In type B, there is also a failure. Price fails to do what? Fails to take out take out the old high and it just continues dropping lower. You get, but it takes out the swing high, the swing low, sorry, and then shoots lower. Ah, any questions? I hope I've helped you. Take good screenshots. But again, the video will be available on YouTube. I'm recording it here. Any questions to do with structure, market structure shifts? Hmm? Yes, Ivan.
Not really a question,
Hmm.
but looking at the market maker buy model type B,
Hmm.
is that how the structure is supposed to look?
Yeah, basically that's how it's.
Because
Hmm.
you see, with the fact with type A,
Hmm.
the old high was like it was crossed out.
Hmm.
Price action crossed it, like it went higher than the old high.
Yeah.
That means in type B it's supposed to be lower.
Yeah, it fails.
So, okay, you look at the structure of type B. Is it
Type B
supposed to be
market structure shift, market maker sell model. Hmm? Here,
a market maker buy model,
buy model. Here,
You look at type
yeah, this is the law that fails to take out what? This one here.
it's actually the law that fails to take out.
A previous law, the old law. In the first example, you're seeing this new law takes out what? The old law and market shifts high. In the second example, this one fails, this second leg fails to sweep the old one. You get here, it fails to sweep it. I don't know whether that is clear enough, but we'll see this in a more refined way as we
Okay, then
continue.
just to you said
Yeah,
the old
maybe.
law,
Yeah. Mm.
the formation at the top of it should not just be an old high, but
Mm.
a swing.
In type A,
That's why I'm asking, is it general? Because you were saying it's not supposed to be just a high, like an old high. It's supposed to be that three candle
like a
formation.
swing. Now, when you see a swing, it can be high, but when you see a swing high,
Mm.
that is a powerful signature. You get?
What if it's not a swing?
Yeah, it doesn't. Yeah, it's okay. It can still be a structure shift. But when you see a swing high, that's called an intermediate term high. Now it changes the name. Now when you see that, and on the left, that swing, there is an inverse fair value gap, and on the right, there is a fair value gap. That's a powerful what? Signature. That you're you're right about you. It's going to work. You get like it's like the chances are high. You get. I don't know whether it makes sense, but we'll see with examples. Don't worry. Any other question? Now, when we go this side on the charts, this is the chart of Nasdaq. Now we're going to start seeing all these things happen. Buy side of the curve, sell side of the curve, etc. For example, here you can see this price slope down, then changed to start delivering high. this one, zoo. You can see that, like kind of data V. So that is a what? A market maker buy model. Why buy model? Because it was sloping down, selling, and now it changed into buying. You get. Now you can see this. It maybe we had a 15-second chart. It came from up like that, dropped, made lower lows like that, then dropped, then went up. Hmm? Hmm. Dropped, deep, deep, you get. Ah, let me stop that there. So that is the structure here. Now when I zoom in a little bit, we can see the market has been sloping. Now it changes route. Now what do we look at? We want to see something like this. The high, for example, this or this being taken out. Now when you look closely here, we have two swing highs. There is this that is almost equal to this, but there is this one that is more clean. That swept what? The previous one. Let me zoom in. This is a swing high, that one that I've labeled with green. Let me make it red. That one that I've labeled with red. Now on the left, here, you're seeing this is also a swing high. This candle, it's also a swing high because on the left of it, there is this candle. It closed slightly higher than. Let me zoom that in so that we can see the difference. I hope we can see this. You can see that this one is higher than that one. So this candle becomes a swing high. Let me put a line. And also this one, let me put a line. You can see that that line, let me give it maybe blue. The blue line is lower than the red one. So that becomes a swing high. Because this candle is in the middle and the last candle is here. That is, let me also make this blue. So you can see that. So this candle in the middle closed higher than the two candles. So it qualifies to be a swing high. Now when you look where it closed, there is a gap. You can see this gap. From there to there. That is a gap. Another swing high that is more clean now was formulated. That took out what? This drop lower. It's here. Actually, when I pull this line to the left, you can see it formulated inside the other gap. And this is a swing high. Why? Because it's a candle in the middle and these other candles on the left and the right hand side of it, they closed lower than it. So it's higher. It's protruding. So this is our swing high. Now we want to see on the left, is there a fair value gap? There is this gap. On the right, do we, people, I will emphasize this. The moment you see this move higher, taking out the previous high, that's a shift. That's enough of a shift. Now you want to see this swing high being taken out with momentum. Now this is momentum, leaving what? A fair value gap. From here, from there to there, that's a gap. Now, the moment you see this candle taking out the sweeping, closing above the left gap, This gap, the first fair value gap, becomes an uninverted what? Fair value gap. Let me write it here. Inverse fair value gap. So this will be our original fair value gap. Now the moment you see on the left we have a fair value gap and an inverse. Okay, let me make this a different color. That, and then this yellow one or orange. That one. Now that is your end, like that is a powerful signature for market to change from what? From selling to now buying, to change its state of delivery from dropping lower to going up. You get, and you can testify it happened. Market continued up, up, up. So that becomes a market maker buy model. That is our first live example. So let's look to see if we have a buy model. Sorry, a sell model. Sorry, yeah, a sell model. Now the same here, just that here it's not yet clean enough, but it's there. But for the sake of studies, I'll look for something a little bit clean. We'll come back to that maybe in the proceeding lectures. Now the same thing here, price was climbing up like so, and then it changed its state of delivery. How? You can see here, there's that candle. Let me get up one. This is the previous one. This is a type A. The previous liquidity that was swept, and then price went higher. So price shoot higher, then drop, then higher, then drop, then higher. Then again took out this liquidity. Here you can see these candles. Let me zoom in for you. You can see these candles took out this. So this is a type A. Then it dropped, then went up, created those two lines. But now what formulated low? A swing low. Let me mark it. That candle. So that is our swing, one intermediate term low. Now when you look on the left where it formulated, when we pull this on the left, there is a gap. Actually there are gaps, like there is this gap. There is that gap. Let me make it maybe a different color. There is that gap. And then what are you waiting to see? For price to drop. The moment it drops with momentum and it leaves these gaps here. And those gaps are in line when you look on the opposite. They are in line with other gaps. These gaps. They are in the same line. Just know this is a key signature that we are now going to drop lower. We've changed from delivering higher to now delivering lower. So this is a market structure. Market structure, sell model. And this here, it's a unicorn. It's some advanced stuff, but it's easy to understand and it get the job done every time. Now your targets will be these old lows, this one, and there's a gap there, this low, like that. Those will be your first what? Stop loss. Actually, later on, price comes back inside those gaps and then again drops low, taking out these lows. But here, this is a powerful one. Just that now it can confuse you because it again came back and then went back up. It made two, it created two swing lows. We can see them here. This one, that one. Let me change that to gray. That one is also a swing. So those are two that are waiting to be swept. For you, you'll be waiting on your computer, waiting for what? To see price drop lower with momentum, leaving gaps, closing below these swings. What I'm now referring to as intermediate term lows. You get these two. Intermediate term low. One and then two. Those ones. The moment you see that, you expect price to do what? To come back in this first gap. You put your entry there. Your stop loss above that would mean what? Uh, Fair value gap. Market will drop. The same thing, it happens over and over, over and over again, over and over and over again and again and again. But to be realistic, it's not easy. It's not. If you don't apply time to it, you might get confused on why things are not doing what working. So in the preceding lectures, we'll look at time and how to merge these two things, these two elements. Okay. It happens over and over again and again. Again, it's here. It's here. And it's on the bigger picture here. So this is a swing line. When you look on the left, there are gaps. And then when you look on the candles that swept it, they also formulated gaps. Boom. Even up here, the same thing. Even here on these swings, you see this is even a volume gap imbalance. On the left, just know you're sloping down. So with that, allow me to stop the lecture here, unless there is a question. I hope today you benefited a lot. This is what we'll be looking at, and this is also what I use to do what to find trades. Thank you very much. People are appreciating. Yeah, so we're going to keep it simple. We'll just use this structure and you see how it works over and over again. It's simple to tell. Yeah. Now the other things will be your order blocks. You decide what you want to use, either to see an order block or to just use fair value gaps. Yeah, I think by saying great lesson. Thank you very much for being attentive also. For being please, I hope you've taken notes. So anyway, I will request someone to give us a closing prayer and also remind you that you need to go to the charts and try these things and locate them and try to relate them to your notes. If there is a question, I'm always on WhatsApp, you can ask, I will answer you. Or you can drop it in the group if you fear to text me or answer, or you can share it with Alvin or even Cypher. Is always there to help. Will be ready and to help you. But this is really key. Let's get, if you've been studying other things, this is like the core. Things we've discussed today, this is the core. The only element that is remaining is time. And when we tap time and add it to this, and you repeatedly use this and practice it, a whole new world is going to open without much worries. So you're going to know, otherwise, in other words, this week, by the end of this week, everyone should be able to know what they are looking for in the market on the charts by the end of this week, if it all goes well. Not that I'm also not feeling well, but we'll see how it goes. Anyway, let me give this opportunity to who I don't know who is ready. Cypher or Ivan prayed for us. Or Faz, whoever, or Alvin, I see Alvin is here. So either Cypher, anyone who is ready. To give us those closing remarks and the prayer we, yeah.
Okay, let me pray
All
because
right.
I'm sync responding.
All right. Thank you very much.
Maybe my closing remarks are really like, man, bro, I don't know what to say. Personally, I'm humbled, man.
Yeah. Thank you, man.
I just don't, I don't have words to describe such a heart, describe such an effort. But either way, may the Lord grant it to you the way you wish, my bro.
All right, man. Thank you.
Let's pray.
All right.
Father, thanks for today. Thank you for the lecture. Scripture says, get wisdom with all thy getting. But it says, with all thy getting, again it says, get understanding. Father, we thank you for the instructions. Thank you for the wisdom, but we want to thank you, Almighty Sovereign Lord, that you will help us interpret the things with a clear understanding. Father, I want to thank you for the team that is in charge of all this, the people that began this, Heavenly Father. Lord, if it's shooting heights to the maximum, they must touch the limit. They always say sky is the limit, but I must pray, Heavenly Father, that the group that began this should go beyond the skies. Father, I want to thank you for every soul that is following this. That to this level, mighty sovereign Lord, the end of this must be a very big testimony. The end of this, Almighty Sovereign Lord, should be a person who is also dedicated to give, because freely have we received, surely, and freely shall we give. Almighty Sovereign Lord, may a nation change a sprout out of this. May somebody who will change very many lives in our country with the history that we have come out of this crop. I thank you for each and everything. Thank you for your love. Thank you for your provisions. And I know that even when the month is beginning, we are beginning it with a very big energy. In Jesus' mighty name, I pray and believe.
Amen. So thank you very much. Thank you people for also keeping up, trying to show up. Yeah, that was a wonderful one. We hope that this is for the good, and we hope that if this information is not taken for granted, it's used. These people put this into action, try to look for these things. They might not work for the first time, but when you try to look for them, they will start making sense. That is our focus. Yeah, we don't want people who gamble. No, that's not the cause of this. We want people who know what they want, who know what they are supposed to look at, to find. And the moment you don't see it, you just know that you're not going to take that trade. You pause, you wait. Maybe you come back the following day, and the following day, and the following day. But in the meantime, in the meantime, you keep practicing, keep sharpening your knowledge, your understanding. But rotate it around only these things. Don't try to grasp a lot of ICT what terminologies. It's not necessary. If another block has failed you, like you just keep it to fair value gaps. As simple as that. Actually, me myself, I don't even use other blocks to refine my entries. I've just started doing one using other blocks recently, but I found them also hard. But there are people who are like fine and they don't use fair value gaps or entries. They use other blocks. They use mitigation blocks. They use all that. But it's also good to know the mechanics of this. You get, but we keep it simple. I'm not trying to complicate things. We are trying to explain it the way we also understand it in the simplest way possible. So I hope this helps you, and in time you never can bring in some income. Yeah. So thank you very much for listening in. I don't know whether anyone has something to say, Saifa or Alvin, but if there is nothing, then we can close up today. Yeah, in its time. Oh yeah, Alvin. Okay. Mm, yeah, so people as we
Yes. Good evening.
yes, good evening, Alvin.
Good evening, Will.
Good evening.
Good evening.
Yes, good evening to you. The mic is yours.
Thank you so much for the lecture. We appreciate. I've been on and off, but at least I've managed to learn something also. So I appreciate you for presenting. I appreciate Ivan for the prayer. I also appreciate whoever has attended this session. So we never had this session in the morning simply because I'm planning to make a beginner's guide for beginners, like a complete video that is going to break down everything that a beginner requires to start or to know about trading. So, because you will find out that most people in the group are like beginners. So, I'm trying to work on that. And also, thank you for those guys that have contributed for the internet.